Welcome, everybody. We're just waiting for
Welcome.
everybody to pop on in here, and then we're going to get started with our presentation. We're super excited to have everyone here.
That's great.
Okay. We're talking about how to be able to get into home ownership, battle some of those challenges that many folks are experiencing when trying to get into home ownership. So we'll give it one or 2 minutes here for everybody to join in. Just a few housekeeping notes. There is the Q&A section that is available in the webinar. So please feel free, as you hear some stuff and you have questions, be able to pop that into the chat. We might not be able to address it right away, but we will make sure that we do address all questions and that are along the process here, and we'll make sure that we answer all of them by the end of the presentation for sure. But we're very excited to be able to deliver this information to you guys tonight.
Amazing. Yeah, so we're just going to wait a couple more minutes for a couple of people to sort of roll in. Got some great attendance tonight.
Okay. So many of you have joined, connected with, been chatting with one of the realtors from the JJ team. We get to work closely with all of those lovely folks and being able to help deliver some great educational content to their clients that are looking at being able to purchase homes. So we're excited to be able to collaborate with everyone tonight.
Yeah, I think we have a couple of the EXP JJ team agents online here. I see Lindsay. That's great. Sam's there too. Hi, Samantha. Wonderful.
Okay. All right. So what do you think, Steph? Are we ready to get started?
Yeah, we're 503, or sorry, 703. So yeah, let's.
Steph's in a different time zone.
I'm in a different time zone, so.
All right, fantastic. Everyone, welcome and thank you so much for being here today. As Steph and I were just mentioning here, we're looking forward to chatting with you and giving a little bit of experience in regards to some of the obstacles that we're facing and about trying to get into home ownership in today's interest rate and market environment. So I would love the opportunity to just talk a little bit about who we are. So Steph Edwards and myself are both mortgage agents with the In Debt on Purpose team, a team member of Vine Group Mortgage Brokerage. And we've had the pleasure of being able to collaborate on many occasions with the whole Jennifer Jones team and all of their realtors to bring great content like this to everyone here. So we're going to get a little bit started here. And Steph, I'm going to hand this portion of it over to you because Steph is really great with the economics portion of everything and taking all of this data that the government's giving us and being able to translate it into something that we all can understand. Steph, take it away.
Amazing, thank you. So basically, right now, there sort of used to be this sort of old adage that it used to be between like the have and the have-nots, or the wealthy and then the people that aren't wealthy. And the dynamics of the way that things are changing financially for Canadians, it's changing, and it's changing more into a situation where it's homeowners versus renters. So the people that are the wealthy are people that own real estate, and that there's a substantial difference in the people's net worth, versus someone who owns a home and someone who has always rented. And, very, very recently, this report from TD Bank had come out, and they basically monetized that number. And they said that at retirement age, those individuals born between the years of 1955 and 1964, there was a difference of $1.4 million at retirement, okay, between homeowners and renters. And that was very significant. And this gap, it's increasing dramatically, because the last time when they compared this this study, they looked back in 2005 and that the gap was only 500,000. So now that gap has almost tripled. And this is one of the things that, like, in debt on purpose, as you can probably tell from, the name, in debt on purpose, is that we want people to be in debt for a purpose, either for investment purposes or to help build wealth through real estate, which is, owning your own home, right? So that's the whole premise of what we're trying to kind of bring you today. So I just want to briefly, we're going to basically put this presentation into 3 segments. We're going to try to keep this really, really tight. And so we're going to go through sort of 3 sections. So the first thing we're going to talk about is the current economic status right now. What does the world look like, for people who are renting, buying? And then we're going to talk about the 3 most common challenges to home ownership. You're probably going to fit into one of the 3. And then the last thing, and the thing you're probably most excited about, and you probably wish that we are going to start with this is the show me the money part of our presentation, right? Where we're actually going to give you some real strategies that you can use and implement to get you into home ownership faster. Okay, so let's talk about, you probably live this. If you're renting right now, or maybe you're a parent or a grandparent, you're watching this webinar, this is where you are. And rents have been increasing. I mean, obviously this chart only goes to January of 2021. And we did see a fairly significant increase, during COVID, but it's not just because COVID that rents have increased, okay? And, you've seen that your average monthly rent, has increased substantially. Now, even with the variance of this, the long-term trend is that, rent is going to continue to increase, right? Because housing prices are going up. So what is the main indicator of why rents jumped up so quickly and dramatically? And that's because of this chart here. And it has to do what is happening to the supply in terms of the demand on how many people need rental stock. So I thought this was a very, very interesting chart. This is actually from CMHC, and it's a little bit busy, but basically what it is it's breaking down for everybody how many work permits, study permits, asylum, refugee status, and not necessarily permanent residents are coming into Canada. So these are non-permanent residents. So when we talk about permanent residents, okay, we're talking about people who have PR status and they're landed immigrants, right? They're going to stay. These columns here, what we're talking about, these are here people temporarily, right? And so they're not buying, but they're renting, and they're putting a big demand on the actual rental stock. And this, is not really going to change, although the government did say they were going to cut back a little bit on some of the work and study permits, but for the most part, because we do have a large wager shortage, the work permits are going to continue, and then add on numbers of, permanent residents. And so within 2024, I mean, we saw a huge increase in our population growth, about 6% of total population increase between permanent and non-permanent residents. And that is really just not sustainable. And the main objective of this is putting pressure on where people are going to live. So whether you're new to Canada or whether you're here already, we're all trying to find, a place to live. So the reason that I'm building, talking about this so much is because if you're renting, it's the pressure of renting an increased rent and trying to find a good rental. It isn't going to ease up. And also the other opportunity is if you're not going to look at buying now or get yourself into a plan, when are you going to do it? And the supply issue is not going to go away. This chart basically indicates that we really cannot build homes fast enough. Now, there's a part of the chart to the left prior to 1990 that you don't see. And this indicates that back in like 1979 was the highest period in Canada where we built the most homes. So we're talking about rental, single family, and condos. So just think about this for a second. 1979 was when we had the most total construction homes across the country. Okay, so not just Toronto, this chart showing Toronto, but across the country. And we were just under about 250,000 at that point. So I find that shocking that, 40 years ago, we built the most amount of homes that we possibly could. And ever since then, we've never been able to build as many or more new construction homes. And when you're thinking about owning a property, the line that I think that we have to be really, really worried about is the blue line, single family homes. So over the last 30 years, that line in Toronto in single family really hasn't increased at all, right? And so this is really shocking, and this is going to continue to put that demand on existing housing supply, okay? So simple law of economics is that when you have a lot of demand and you don't have a lot of supply, what happens? Well, this is what happens. Just wait, one other thing. This was new construction. So the next slide, Christina, pull that back up for me. This is active listings. Active listings is MLS data. So these are people that own homes and have put their homes up for sale. So not only the previous slide showed that we have less and less new construction being built, but there's also less and less MLS listings that are coming onto the market. Okay. And so this slide is going back to 2010. And we have been on about a 16-year trend of less and less MLS listings available. Okay. So again, why am I bringing this up? I'm bringing this up because again, there is a lack of supply. And whenever you have a shortage of supply, it's going to increase the demand for the price of homes and therefore drive up the average prices. So we've got this nice a chart here that our team members at eXp Realty, Jennifer Jones, they pulled up for us. And we're basically looking at, Georgina, Barrie, New Tecumseh, and Innisfil. And the main thing is that I want you to look at is that when you look at each chart from left to right, what happens? Price goes up, right? Prices are going up. And the idea is for you, if you're renting, is where do you want to be in this chart, right? So it's difficult to say, hey, I want to buy at a dip, or I want to buy at this particular period when housing prices were low, and then look, they went back up, then they went back down. I mean, we don't want to be worried about that. What we want to do is think about time in the market as opposed to timing the market. And if we were to draw a line to the right and continue with the trajectory of sale prices of homes, it's going to be going up, right? And we know that for a fact historically, over the long term, that prices are going to go up. So again, how much do you want to pay today versus in the future? So the other thing last thing I want to say here is about implied Bank of Canada policy rate. Now, I am sure that Canadians over the last 2 years, 2.5 years, you have never heard so many people talk about the Bank of Canada, okay, the prime lending rate and inflation, okay, like honestly.
Absolutely.
And yeah, and personally, I have a very strong background in economics. I find it hilarious that everybody is espousing things about monetary policy all the time. So it's really funny. So I feel like if I see one more social media post about inflation or something, I'm gonna kind of lose it. But anyway, everybody's really, really focused on this. So why are they focused on it? Well, they're focused on it because this next chart, when we are finished with a tightening period of bank policy, this is what happens. Okay, so look at this chart. All right, so it's a little bit busy. So we basically took the last 4 periods of a tightening policy of the Bank of Canada. So tightening meaning interest rates go up from the Bank of Canada and then they pause. Okay, and then what happens to home prices after a year, 2 years, 3 years, 4 years, and 5 years? So I want you to look at the red column to the right, right? So Christina's circling this for us. So what this means is that on average, prices after a rate pause, which we've had, by the way, right? We haven't had any rate increases since the summer of 2023. What happens to home prices? Well, on average, 1 year, they go up 3.5%. After 2 years, it's 7.5%. After 3 years, it's 12%. 4 years, 17%. And then after 5 years, the average home price index increased by almost 25%. So again, I'm trying to sort of instill that there's a little bit of some urgency here, that we are going to get back into this cycle of higher prices, right? Historically, we know that's true, and we know that there's a supply issue that is not going to go away.
Awesome.
Okay.
Thanks, Steph. So now we've got that little bit of depressing news. Let's go into some exciting stuff
Yes,
to talk
it's a
about,
little bit
right?
of a
How can
negative
we
Nelly.
capitalize, right? But how can we capitalize on this? This is we know that prices are probably going to be going up based on historical trends, because interest rates are going to come down. Those prices are going to go up, and that's just based on demand. And so now the challenge is, how do we get those of you that are renting into that home ownership? And what we really discover is that there's really three main barriers that contribute to the reason why we're having challenges getting into that home ownership. So one could be about credit. It could either be capacity or capital. And by capital, we mean down payment, right? So typically fall in one or more of these three categories. And so what we want to do is talk tonight a little bit about each of these different options and what might be available to help support you and be able to solve one of these three challenges, okay? So in terms of credit, whenever you're looking to be able to buy a home, our lenders are going to be looking at your credit history to be able to determine how much mortgage financing we could be able to provide you with, and what is the likelihood that you're going to be able to pay that off. And so there are many contributing factors to what contributes to your overall credit score. So we've just kind of given a chart here just to show you the differences on how it contributes to your overall credit. And ideally, for traditional lender financing, your banks, your credit unions, your monoline lenders, for example, we look to see a credit score of about 650 points. So that the top score for credit bureaus is 900. We call those the unicorns. We rarely see a full, complete 900 score, but the happy medium range is 650. Okay. Now, interesting enough, I don't know if anybody's been familiar with, but you can have never missed a payment on your credit bureau, always made payments, but have a really low credit score. And one of those contributing factors will actually be based on the utilization of the credit card or revolving credit facility as well. So you live anywhere at, near, or over limit of your credit limit, then you can actually have a lower credit score because of the way that you're utilizing that debt. So keep that in mind. Always operate at a running balance or of 50% or less, or better yet, pay it off in full every month, right? So in terms of some credit challenges, that may be a conversation about what can we do to help you support that by reviewing that credit bureau report. Take a look to see if there's any inaccuracies. How do we get into a schedule, being able to pay those bills on time? And it's about analyzing too, in terms of how can we help you to be able to eliminate some of that debt? Maybe it's prioritizing what those high interest rates are, creating that custom plan for you to be focused on. I think one of the big challenges is having that support and that guidance to give you some direction about what are the things that you can do to be able to improve your overall credit history, right? And that might be even as simple as having a debt consolidation, combining everything together to create a good repayment plan. And when we go on a path to being able to help our tenants who are looking to be able to get into homeownership, we also will explore their savings, down payment goals, and how we can be able to build that up as well, and getting you prepared with the necessary paperwork and everything to be able to then get into your homeownership. So it can be a long journey over time to be able to get something put into place. But that's around starting and originally with the credit. There are some other programs that we want to chat about today that is, I think, a really good eye opener as to why you might actually be able to get into the market now when you thought you couldn't. Okay, so let's talk about showing you the money and how we were able to get there. So, Steph, I'm going to let you take over on this program about some of the different programs that we have for immediate help to be able to get into home ownership. Did you want to
Yeah,
highlight just
thanks.
on the federal program?
Yeah, so there is a federal program, and this is a little, tongue in cheek here that I've written ineffective, because it hasn't been a program that's been really well received, because it's a program that the federal government launched, but what they did is they put a cap on your income, and depending on where it is that you live, you were only going to be able to borrow like 4 times, your income for a purchase price, right? So for example, if you lived outside the GTA, basically it was 4 times your income. So let's just say, for an example, say you're living in Kitchener-Waterloo, and your household income is 100,000. Well, according to the program, you could only buy a property for 400,000, right? And so what is it that you're going to be able to get for that amount? And so outside inside the GTA, they increased it to 4.5 times, but still, in the North Toronto area, we were talking about Georgina and Innisfil, Newmarket, Aurora, Barrie. What are you going to find for 450,000, right? So I'm not going to spend any more time talking about it because it's actually not that effective, but there is a pretty good program from Simcoe County. Okay. And this is actually a really, really good program because it's basically a grant system, and technically a forgivable program depending on how long you own the home. So it's only for people who are renting in Simcoe County, Barrie, and Orillia. Okay, so you have to be renting. You cannot live in your parents' basement or be living, with a relative and paying room and board. It has to be like an actual landlord, separate unit. I'm paying rent. Okay. And the whole reason is what they're trying to do is free up rental housing stock and get people into actually purchasing. So there is a maximum purchase price of $712,300. Okay. Resale or new home. So it can be new construction. And they'll give you a maximum of 10% down payment of a grant, the maximum of $50,000. Okay. And there also is a minimum net income requirement. So again, net income before tax of $121,500. And they're also indicating that if you're contributing like gifted funds or personal assets, you can't have more than 20,000 yourself. So it's not a program where it's like, oh, I've got $50,000 or $60,000 saved. I'm going to get 50,000 from Simcoe County and add to my down payment. So it doesn't work that way. It's really for people who have really strong income, good, strong credit, but you just don't have the down payment funds. Okay. And the repayment is great. Basically, if you never refi or sell, there is really no repayment after 20 years. And even using the 50,000, there are no payments or interest or anything like that. You just have to give them their share of that down payment back if it's less than the 20 years. So this program, I think, is a lot better than the federal grant program because it expands the maximum purchase price out, and it also goes into sort of some more sort of northern Barrie, Orillia, Simcoe County areas where hopefully we can get into that purchase price. So this is actually a pretty good program, and I've been in contact with Simcoe County, and they're still running the program, and there is a pretty simple application progress. But again, talking to Christine and I, depending on your situation, we're going to be able to assess what basket you're going to be able to come into, right? When
For
we
sure.
meet with you. But I love
And
this
you'd be
program. I think it's great.
And even outside of this municipality, there may be other municipalities that also run similar programs. And that is something that we would investigate when we're chatting with you as well, to explore, to see if there's other programs that are similar to that as well. All right. So let's talk about a shared equity partner program that is better than the one that the government offers to be able to have.
And it doesn't involve you living with a roommate, by the way.
That's right. Yes, exactly. Exactly. So the shared equity partner program has created some more interest in ways for be able to get into home ownership that address both the capital and the capacity challenge that most people have when getting into home ownership. And so the idea is, you earn a good income, you've got a good household income, and I think the struggle is real. You say, oh my gosh, we as a family, we're making $100,000 or more in income. We started saving in terms of the down payment. We just don't have enough to be able to contribute down. Our credit's good. How do we get into the market? The shared equity partner is able to add their down payment portion to bring up your purchase price. So the minimum is that you do have to have 5% saved to get into this. And the equity partner will contribute up to 15% of that contribution. So the whole goal is to get you to 20% as a down payment. And why that's important is because at a 20% down payment, you can actually have a 30-year amortization. So there's a difference in terms of what you would qualify for a mortgage financing when you're utilizing a 25-year amortization versus a 30-year amortization. And so this shared equity partner is going to help put that home ownership a little bit into a closer reach for you. And so there are specific geographical areas that the shared equity partner will participate in. So we are looking at more urban areas, and but they are expanding right across southwestern Ontario continuously. So that is something to be able to investigate further on whether or not is in your specific geographical area. But I mean, Kitchener-Waterloo, Toronto, Burlington,
Guelph,
Niagara region, Guelph.
Cambridge. Yeah.
Yeah, there's a lot of areas in here that allows that. And it eliminates what we call as a high ratio mortgage. Now, I don't want to get into a lot of acronyms here, but basically a high ratio mortgage is when you have less than 20% down, you have a default insurance premium that has to be added into that mortgage. So there's kind of more fees that are built into the mortgage. That doesn't exist when you have 20% or more as your down payment. And as mentioned, we get to be able to extend out to that 30-year amortization, which does one of two things. It either increases the property price that you can be able to go for, or it's also going to bring your mortgage payment down when you can do a 30-year am versus a 25-year. Now, the nice thing about this shared equity partner is that the funds that they provide, that up to 15% down payment contribution, there are no interest payments. There are no monthly payments that are required to be able to pay these funds. It is a joint ownership in terms of the property. You own the title. They're just helping to contribute with the down payment of that. And that is what you would be looking to pay them back when you're ready to do so. But I want to show up how it can actually truly make a difference. So with the shared equity promotion, if you had 10% down, they come in and contribute another 10% to give you that total of a 20% down payment. That purchase price we'll use as an example was $730,000. But if you only had just your 10% portion, not the additional 10% that was coming from the equity partner, your my apologies, that purchase price would be about $600,000. So that's a big difference in terms of what you would be able to look at in terms of a purchase price. That 25 to 30-year amortization spread can make a big difference. Okay. Now, in terms of repayment, this is a split on the equity that is in your home. So let's use an example of $1 million purchase. Okay. $1 million purchase requires that 20% down payment, which would be $200,000, right? If you had 5% for your contribution, the equity partner would come in with the remaining 15% contribution. So you would have contributed $50,000, they put in $150,000. And so really, when you look at that 20% total down payment, your contribution was 25% of that, and their contribution was 75% of the down payment, right? So to sell that home or refinance that home later, you're going to need to repay back their 75% portion of the equity of the home. So if that same home that was $1 million is now worth 1.5 million, your mortgage started out originally as 800, but you've got 700,000 remaining. You paid 100,000 down to your mortgage. You get all of that principal pay down on that mortgage. Okay, that's yours because the shared equity partner, they didn't help you to pay that mortgage payment. So you get that money back, right? You each get your original down payment portion that you put into the investment, and then the growth of the real estate property, that is the portion that is the 25-75 split based on that original contribution into it. So that example there, you would actually get $175,000 and the equity partner would get $525,000 for their contribution. Okay.
Yeah, so
And so
Christine, I'm glad that you pointed out that it's net after the mortgage payment. So because there was a question in the chat that says, well, do they also get a share of the mortgage pay down? And you answered that, really well, that they don't get a share
yeah,
of the equity pay down on the mortgage.
exactly. That's yours to spend. And the neat thing about this too is that, this, you get to own this home and you get to do that now, as opposed to if you're always constantly battling, trying to save enough money to be able to have enough down payment as the home prices are continuing to increase. It's almost like you're always behind the eight ball, right? You're always trying to save more, and the house prices increase. So you got to save a little bit more, and then the house prices increase, and you're constantly playing catch up. So this allows you to get into that market. And yes, we do have to owe them back some funds, but would you rather have 20% to 25% of something versus 100% of nothing, right? Getting into that home ownership market. So the idea with the shared equity partner is that they will be your partner for up to 10 years. At the end of the 10-year time frame, you would either sell your property and be able to pay them out, or you would refinance your home and you would be able to give them the cash contribution. Then you'd be in a position to take that mortgage over for yourself. Okay. You can sell it earlier than 10 years. You're not obligated to hold it for that whole 10-year time frame. It's just when you do sell, that's when you're being able to pay them back their portion of the equity growth. Okay. All right. So I think we're just going to go through. Steph, this one's here on the economics of renting. I think you're going to chat about that one here, but the differences between the cost, right?
Yes, I'm sorry, and I'm just replying back to one of the questions here in the chat. There we go. Okay, perfect. Yeah, so let's just take a step back, and look at the actual economics of renting. So here we sort of compared a situation of someone who purchased a home versus someone who had rented a home. And what we're doing is we're really just looking at, what's the equity position after 5 years. And so basically after the 5 years, you come away with equity, less mortgage, less property value of 302,000 after 5 years, versus the situation of someone who's renting. Obviously, you've got your total yearly rental cost, which is almost $30,000 a year. But then we also factor in the lost opportunity cost of not being able to access the equity of the home. So, it's pretty substantial when you look at the loss of that opportunity. And that's why I think in today's day and age, we have to look at a little bit different ways of getting into home ownership. It can't always be, the bank of mom and dad, or grandparents gifting. Now, if they want to, and they're on this call, we'll take it. We're super happy about that. We've got gift letters that you can disperse to your family members. We're happy to do that. But we have to evaluate other methods. Housing prices continue to go up. Our incomes are strong, but it's not the same as it was 10 or 15 years ago. right? Things were a little bit different back then, and now we have to look at different types of strategies to be able to get us in there. So we kind of like this, here's those housewives here, and people think, well, interest rates are too high and, they don't want to pay 7% on a mortgage, but hey, guess what? Rent is 100% cost, right? Because you're not getting any equity out of your home whatsoever.
Love that. Okay. Up next then is the next option is what if we want to be able to get into a property and we've got credit issues, maybe challenges that we need to be able to work on before we can actually qualify for that mortgage. What options do we have?
Yeah. Yeah, so
Okay.
this is a really, really good viable solution. And if you're a real estate partner and you've got clients that are really battling with 2 out of those 3 C's, the rent to own is a great program because we can take a client again, and we're going to assess them. What program are they going to be a candidate for? So it could be that, maybe your income is not great, it's not provable, maybe you're newly self-employed, maybe you've got a major credit issue that you're battling with, and it's going to take a couple years, but you don't want to miss out on, the housing market. So where rent to own happens is that you have to have a little bit of skin in the game. So you have to have some money in order to contribute. Okay. So in some cases, it can be as little as $15,000. And we have to have a very, very specific plan for how you are going to be able to eventually take over a mortgage on this property that you're renting. So the basic premise of the program is that you and your realtor partner, you go out and you look for a home given a pre-approved amount that we've already calculated for you. Okay, so based on the estimation that your credit's going to be repaired and based on your income situation, we know that you can go out and look for a home for $600,000. So what happens is we've got an investor partner. They come in, they purchase the home for the $600,000. You pay rent to that investor / landlord for whatever the set period of time is in your contract. So it could be 2 years, it could be 3 years. But the nice thing about this is that you're actually renting the house that you're eventually going to buy. Okay, so you're going to get title to it and you're eventually going to get a mortgage on it. So there's a little bit of legwork that we have to do up front for this type of scenario. But again, for some clients, this is a really feasible way of being able to get into home ownership. Okay. And so, there is certain criteria, again, that we have to go through to make sure you're qualified. And this is a program that we can pretty much use all across Ontario and even in additional provinces. But you have to be able to, you're owner occupying. Okay. So you're not doing this as a rental property or something like this. This is your house that you're going to rent and eventually you're going to own it.
Love that. Great option. Okay, and next up is about a borrowed down payment. So how many people know or have heard that you can be able to buy a home with 0 money down, right? And it's not something that's necessarily talked about a lot. And it really isn't about having 0 money down. It's about how do we work our finances to be able to acquire that mortgage. And that could be is if we have the income and the capacity to be able to take on additional debt, including the new mortgage that we would be set up for, then you could do a loan or a line of credit to be able to come up with the money that you would need for the down payment to solve the capital issue, the lack of down payment. So there's some creative ways that Steph and I have been able to work with our clients to be able to put this plan into motion. So it's not just about being able to, get a line of credit and have some funds available to be able to utilize as a down payment. One, you have to be able to have the income to service that additional debt that is being taken on. And there's only a few certain lenders that will actually utilize this program. So we do have to be very specific with who we're targeting in terms of obtaining your financing. But then the second is how do we make those dollars work for you even further? So in one scenario, we were chatting with a client and they had the capacity to be able to acquire the borrowed down payment and to be able to service it to get into home ownership. They said, listen, we're almost at the end of RSP season. And as a first time home buyer, if you put money into your RSP, you get to pull that money out tax free towards the down payment of your first home. But here's the thing, if you put that money in now before the end of February, then this was going to count towards your income taxes for the 2023 tax year. So if you then are able to file your income taxes, you're going to get a nice tax refund for that contribution that you made into your RSP account. So in this example here, they were able to do a $20,000 RSP loan and did a contribution into their RSP account. When they filed their income taxes, they're going to get about an $8,000 tax refund. And they could do one of two things with that. One, they could take that $8,000 and they can apply it to that RSP loan to reduce it down to $12,000 and continue to make payments on that loan. So it's like a really good forced savings plan. Or you can take that $8,000 and you can use that as additional down payment and or to cover the closing costs related to your new home purchase as well, and then continue to be able to pay the debt down. So there's some creative solutions that we can look at that can help actually lift the amount of funds that you have available, and knowing between the RSP program and the new first home savings account program, how can you be able to take advantage of those and make those programs work really, really well for you? Okay. So at the end of the day, the first step to take is to be able to sit down and talk about your personal situation. And that's where Steph and I come in, and being able to run an analysis on your current financial situation, what your goals are in terms of the home ownership, where are you at right now, where are the gaps, and how can we help put you on that path to be able to get into that home ownership. And so at the bottom of our screen here, and we'll also put it into the chat, is a link for the a one-on-one appointment where we can chat one-on-one to be able to put you on that path to home ownership and get you there sooner than you thought would actually be possible. So we're going to take a moment here to open up for any questions and answers that you guys have. We'd love to be able to chat with you and go forward from there.
Yeah, amazing. Excellent.
Awesome. Thank you.
Okay. So there's so just one question here in the chat about RSP contribution room. If you wanted to take advantage of that program, and yes, the way you would figure out is what your contribution room is, you would look at the previous year's notice of assessment. And that would indicate to you how much unused contribution room you have. Yeah. So yeah, well, that's a great question. And I think like a lot of these programs, like they're very sort of individualized. And so I think that, you know, by taking that time to sort of assess where you are, and like Christina said, to make a plan is very, very important, right? And, you know, given the fact that we know that the cost of housing is going to continue to increase, and we know how important it is to be able to have home ownership to build wealth, you know, for ourselves, you know, taking the time and energy by, you know, attending this webinar, and taking the time to take things the next step and say, you know what, where is my assessment, right? And where is it that I can go in order to get into this? I think that that's really, really important.
Absolutely. Yeah, for sure. Actually, there's one more question too in regards to the shared equity. Because it's a property that you own, they're talking about being able to do renovations to that property. And is that something that you can do when you're sharing that property with somebody else, although not physically, right? And yes, absolutely. Even with the rent to own, that's a nice feature to be able to have. You're putting money into something that's yours, right? Minor renovations, absolutely, with the shared equity partner is something that you can do at will. And they actually have some contributory programs that related to major renovations. So if you were going to do a major renovation to that, they're actually going to assess that renovation that you're doing and what the cost of that will be, And because they're not necessarily financially contributing towards it, but that does increase the value of the home, they will give you credit for that. So that's an important note to be able to consider when you're being able to do renovations from that home. You don't have to wait on those renovations until you can buy them out. You could do those renovations and get credit of that towards the amount that you're going to be required to pay them back as well. It's a great question. Thank you.
Yeah, there's another question here about the rent to own, and around the purchase price of the property. So what happens in your rent to own contract? You know, if you're entering into the contract in 2024, and the idea is that by 2026, you're going to exit the rent to own and purchase it, take title transfer. In the contract is going to be a purchase price that you're mutually going to agree upon. Okay. So, you know, it does, you know, it's not that you're going to pay today's price 2 or 3 years down the road. There's going to be a certain amount of appreciation that's going to be added to the value of the property to take into account that you're purchasing the property down the road in 2 to 3 year period. So,
Awesome. Great questions. Well, listen, thank you everyone for being here today, this evening, spending your time with us. We really appreciate it, and we look forward to getting you into home ownership sooner so that you can participate in part of that $1.4 million richer in retirement.